Hello, everyone. This is Zach Gardezy. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, on the 4th of July, the president signed into law the One Big Beautiful Bill, which some are calling a tax bill, some are calling a fiscal bill. Really, ultimately, it's a financial overhaul that's got a lot of changes to many facets of daily American life, but I'll focus today primarily on the changes to certain tax policies, those that I think are most relevant to Wealthstone clients and high net worth individuals. But additionally, I'll focus on also busting some myths that are out there too. I've been hearing and having discussions with individuals about what they think is part of this new legislation, and there are some things that didn't make it through. So there were some things that were promised on the campaign trail. There were some things that were in the original House bill, and then when the Senate got their hands on it, then there were some changes that were made. So there's a lot of confusion. Even reading certain articles online, I see some inaccurate data being shared. So I wanted to provide a comprehensive video. Now, I will be reading off of the screen here today. So if you see my eyes looking elsewhere, I want to make sure that the numbers and the data that I quote you are accurate. And that way you have a full scope of what exactly is changing. Now, these changes, for the most part, some are taking effect right away. Some are even retroactive. And then some, or really a lot of it, takes effect at the end of this year, beginning in 2026. So let's get started in reviewing what are the changes from the One Big Beautiful Bill. So, change number one is all about TCJA, which was the Tax Cuts and Jobs Act that was passed back in 2017. Now, some of the key changes from this particular bill was that it brought down tax brackets and it also increased the standard deduction for Americans. Now, the TCJA was supposed to expire at the end of this year. So, if this bill didn't pass, then everyone's standard deduction would have got lower and everyone's tax brackets most likely would have got shifted higher. We would have gone to pre TCJA levels. Now, what is the standard deduction? So, uh, if you don't have a lot of deductions to itemize, for example, if you're not a business owner, if you don't own, rental properties, or if you don't make large charitable contributions, then it most likely doesn't make sense for you to itemize your deductions because the standard deduction would give you more deductions and lower your taxable income. So that's ultimately the decision making process that people make when they file their taxes, whether it's their accountants or whether they do it on their own. They compare, right? Do I have more itemized this year? And should I take the itemized deductions and list all these things out? Or should I just take the standard and make it easier? Now, statistically, even before TCJA, most Americans were just taking the standard deduction. So pre TCJA, 70% of tax filers were taking the standard deduction. Nowadays, it's estimated that up to 90% of tax filers are taking the standard deduction. Now, intuitively, this makes sense. If the standard deduction is so much higher, this really ultimately took a lot of people out of the market from doing itemized deductions. Could that be better? Could that be worse? I'm not sure, but ultimately it makes things easier for you because you don't have to go in and itemize and keep track of all these things and deduct. And there's a lot of changes to deduction rules over the years as well. So just taking the standard deduction just makes things a lot easier. But for the purposes of overall just paying taxes, incomes have increased since 2017. I know with inflation going up, it's kind of hard to really feel that because the prices of everything have gone up as well. But incomes have gone up. So if incomes have gone up and then the standard deduction goes down, that's a recipe for people paying higher tax rates and just paying higher taxes overall. So it's a good thing that this element of TCJA was made permanent. Now, I want to use the word permanent with an asterisk behind it because it's permanent in the sense that it's not going to expire. It's not set to expire at any point in time. But a new Congress can reverse everything I'm about to discuss with you, right? If the balance of power in Congress changes from Republicans to Democrats, or if there's a new president who needs to negotiate a new large bill, this new president may change certain elements of the One Big Beautiful Bill, right? So all this stuff is about as permanent as whoever's in charge, ultimately. So this is a big change from what could have gone and happened if the TCJA actually expired versus what's now made permanent. Now, I do want to also talk about opportunity zones very briefly because opportunity zones basically, if you have a large capital gain, you can invest your capital gain in an opportunity zone. This was part of the 2017 Tax Cuts and Jobs Act. And by investing in an opportunity zone, there were certain tax benefits that were afforded to you. In the early days of opportunity zones, these were things like giving you a step up in your cost basis, so reducing the taxes that you ultimately have to pay, or other things like, for example, deferring the tax bill for many years down the road, and then all the gains that you make inside of that investment, if you invest for a certain period of time, those gains are tax free as well. So there was a lot of incentives around opportunity zone investing. That was also set to expire or go away once TCJA was expired. Now, this particular bill makes it permanent in a sense as well, right? So remember, permanent with an asterisk, but opportunity zones are back. They've actually been improved. And I'll be making a separate video going into detail about that because it is a very important piece of strategies that I utilize for clients at Wealthstone. So that covers change number one. So another element of this bill, which is pretty exciting, it's the senior deduction. So for anyone who's over the age of 65, there's an additional $6,000 per person or $12,000 for those that are married filing jointly of a new deduction that you can take in addition to your standard deduction or itemized if you're taking an itemized deduction. So this is pretty exciting. It does get phased out at certain income levels. So this is where tax planning becomes very important. You want to work with your tax advisor, your financial advisor, to make sure that you can take full advantage of this new deduction. It's not permanent. It's only going to be around for a few years, 2026 to 2028. So you don't want to miss out on this. And so it's important that you manage your taxable income or your modified adjusted gross income, which is what this is based off of. You want to make sure you manage that correctly so you take full advantage of these new deductions. But it's kind of interesting. This was based off of the campaign promise of making Social Security tax free. Now, ultimately, that's going to be difficult to do because number one, that would push the insolvency date up for Social Security significantly. The whole premise of taxing Social Security came out by the Reagan administration when Social Security was on the brink of insolvency. So making it actually tax free without other systematic reforms is, I think, impossible and ultimately going to make things very difficult for whomever the next president is because the insolvency date now for Social Security is estimated to be 2032. So the next president and next Congress, basically, or the Congress after that, is going to have a lot on their plate when it comes to figuring this out. But at least for the next couple of years, seniors are going to see lower taxes, potentially lower taxes on their Social Security ultimately as well. So this is an exciting new development, but it does bring some challenges for later down the road. So the Tax Cuts and Jobs Act also increased the child tax credit, and so this particular bill actually increases it further. So in 2026, the child tax credit will be increased to 2200 and that will also be indexed for inflation annually. So for families watching this video, there will be some changes to the child tax credit as well. So there was a change to something called the SALT deduction, or what some people refer to as the SALT cap. Now, SALT, SALT, stands for state and local taxes. And this is a pretty unique topic. You don't hear a lot about it in Arizona, mainly because we have a 2.5% flat state income tax. And then also for my clients who live in states that don't have a state income tax, you probably never hear about SALT. And mainly that's because what this is, a SALT deduction is the ability to deduct your state and local taxes against your federal. So what you pay at the state level, deduct against your federal income. Now, the limit today, pre One Big Beautiful Bill, is $10,000. Now, that doesn't go very far if you live in a high income tax state like California or New York. If you're a high income individual, you're most likely paying significantly more than $10,000 in state and local taxes. So members of Congress fought for this and they said, look, if we want to reduce taxes in those states, we need a higher SALT cap. And so it was increased, not just for those high states, it was increased, of course, across the entire country. So it was increased to $40,000 from 10,000 to 40,000, but it does get phased out after an income of $500,000. And this is only through 2029, so it'll revert back to 10K unless Congress makes any further changes. So from a tax planning perspective, there are ways to take advantage of this during this temporary period. And so that's something you want to work with your financial advisor on. But that was a that's a big change for those who live in high income tax states. So another campaign promise that we heard a lot about, and this kind of evolved over time, was tax-free tips, tax-free overtime, and the ability to deduct interest against auto loans where the vehicles were developed or assembled in the United States. All of these elements to a degree have been changed, right? So tip income is not totally tax free, neither is overtime, right? Just like how Social Security was not made tax free either, as I mentioned earlier in this video. But up to $25,000 of tip income can be now deductible. Same with overtime income as well. So you have to report it. Overtime income almost it really always gets reported, right? As long as you're working for a reputable company and they don't pay you under the table, it's going to be reported anyways. It's the tip income piece that's going to trick some people up, right? Because let's face it, there's a lot of individuals who make money on tips. The statistics out there quote, billions of dollars in the economy that are generated from just tip income that generally doesn't get reported. And so, in order for you to take advantage of this new deduction, you have to report it. And so, how people do that or why people do that, I won't even get into that. But why should you do it, right? So, let's say you're someone who wants to go and buy a house. You need to get a mortgage loan, or maybe you're a business owner who needs to take out a business loan. If you don't report the income and the bank requires income verification documents from you, and you say, "Oh, I make this much money, and here, give me a loan for this." If you don't report the income doesn't really happen, right? It's not there. So now this can make borrowing a little bit easier because ultimately you'll report the income, you'll get a deduction for it up to, $25,000. You have to remember it's up to a certain limit. But then when you go to a bank, you now have $25,000 more of income that you can potentially get qualified for additional capital financing. So that's an important element to this. Now, the conspiracy theorist in me says, look, if there's all this unreported tip income floating around and now more of it gets reported, and right now up to 25,000 is tax free, what if that becomes lower one day? What if the deduction changes? What if it goes away completely, right? And if you're somebody who's been in a career or a particular type of industry where every year for the next 5, 6, 7 years, you're reporting $25,000 of tip income, then the laws change and now tips are taxable, and then all of a sudden you don't have tip income anymore. Well, that's going to raise some red flags. So I could see that happening one day. I could see really a lot of things happening, but that's the conspiracy theorist in me who thinks that's probably why this is even happening. But nonetheless, it is helpful for those individuals, right? If you're really more from a borrowing perspective, it's not really going to be helpful from a tax perspective because if you weren't reporting your tips anyways, then you weren't paying tax on it anyways. So that's the big change that we see from tips and overtime. The auto loan aspect is pretty interesting. So up to $10,000 of the interest that you pay on your auto loan from a vehicle where the assembly was made, in the United States, is a pretty big deal. This makes American-made cars more competitive. Potentially, if the prices are very close, if the quality is very close, this can make American cars more competitive. It can also make financing more competitive too, right? Because if you're considering, you know, leasing versus borrowing, or if you're considering paying cash, if interest rates get low enough, it could make a lot of sense to just borrow instead. Now, in addition to that, if you're someone who's in a very high tax bracket, the value of the deduction could be greater as well. So, a $10,000 deduction for someone in the highest tax brackets in a high tax state, this could be a great benefit for you. So, lots to unpack there, but those were the big changes to tips, overtime, and auto loan interest. Okay, so this particular section was a lot more confusing, and I probably spent way too much time, more than I want to admit, on this particular section of the bill. But it's very important because it applies to Wealthstone clients and investors, high net worth individuals who are in the highest tax bracket. So the government now says there's a cap to the itemized deduction cap basically for top earners. So if you're someone, let's just say you make $1 million a year, or maybe you're a husband, wife, couple, you're making $1 million a year, you're in the highest tax bracket, take all your itemized deductions, and maybe you're benefiting $400,000 a year in tax savings. Well, now government says no, you can only benefit 35%. right? $350,000 is what you can benefit. So this creates a bit of a dilemma for those individuals who are in the highest tax brackets or high income individuals. You're going to want to spend more time with your tax advisor and your financial advisor to figure out, does this particular change apply to you? And what can you do to mitigate against this? But this is a pretty interesting nuanced change from this particular bill, and it does apply to high net worth individuals who are in the highest tax brackets. So there were some changes to charitable deductions. Now, just focusing on a couple areas, the P's limitation was repealed. So that's kind of another really niche area of taxes. But also, if your income is over a certain threshold, your itemized deductions were reduced by a certain amount. And so, let's say you had $50,000 of itemized deductions. Your income threshold, you exceeded the P's limitations, then your benefit or your deductions were reduced by a certain amount of dollars, percentage wise. That's gone now. So it's a good thing for high income individuals. There's also a new permanent above the line charitable deduction of $1,000 or 2,000 if you're married filing jointly, and there's a new 0.5% AGI floor for itemized charitable deductions as well. So this new bill does enhance or strengthen charitable deductions, which is a nice thing for those who are involved with nonprofits, 501c3s. It does make making charitable contributions a bit more attractive for high income individuals. So for homeowners, we remember that back in 2017, and there was a change to how much interest you can deduct from what you're paying on your mortgage loan. That was reduced to $750,000 based on your primary residence. So if you had a mortgage loan of $1 million, you don't get to deduct all the interest that you paid on that $1 million. It's only up to $750,000 of the mortgage balance and the interest associated with that. That has been extended now. So that's still the limit, 750,000, and that's made, remember, permanent with an asterisk. And so I've gotten a lot of questions about what's happening with mortgage interest rate deductions, and the way that I would explain this is it's staying the same basically. So it's a good thing for those of us that have mortgages and are paying interest on obviously on those mortgage loans. So I want to focus on a few key areas for business owners. Now, one of those is in the qualified business income, QBI. That's made permanent now. So you can take your qualified business income. That's a calculation you could work with your tax advisor to figure out. And you could take 20% of that and deduct it, right? Now, that was supposed to expire at the end of the Tax Cuts and Jobs Act as well. But in addition to that, there's now a $400 minimum deduction for those who are in such a low, business income where their qualified business income is really not much. And so for those businesses, it creates a pretty neat impact on your taxes, because even if you have a very low level of qualified business income where you weren't getting much of a deduction anyways, you're going to get a $400 minimum now. So that's awesome for anyone who's thinking about starting a new business and maybe you don't have a lot of revenue in the beginning. It makes it more attractive from a tax perspective. And of course, it's not a ton of money, but nonetheless, any additional funds that you can save, especially if we're encouraging small business formation, is a great impact, positive impact to the overall economy. Now, focusing on that same topic, more on the lines of R&D expensing. So, research and development expensing has changed a lot over the years, and the most recent legislation required it to be amortized over a number of years. So, your research and development expenses, those expenses had to be, amortized. This new legislation allows you to take the full, deduction on that right up front. And in addition to that, you could actually go back it through all the way to 2021 and get tax relief, amend your tax returns, and potentially get money back from having overpaid in taxes during those years. So that's really neat. It doesn't apply to a lot of people, but if it applies to you, work with your tax advisor on this to see if you can get some money back on your taxes. Another element of that is the fact that of course, it encourages more research and development. And I think part of this has to do with artificial intelligence, right? That's a key area where there's a lot of research and development expensing going on right now, in addition to quantum computing, robotics. And so, if we want to get ahead as a nation, make it more attractive to invest money in research and development for companies. In that same vein, changes to bonus depreciation and Section 179 expensing. So, Bonus depreciation is now being made at a 100%. So, certain things that you purchase for your business, for example, if you buy a new super powerful computer to create your own artificial intelligence for your company, you can potentially deduct 100% of that in the first year rather than having to split it up over a number of years. And so, this can be really attractive for those businesses who need all sorts of new equipment. Again, let's talk about artificial intelligence to stay ahead of this major change in society. And so there's a lot of other needs for why businesses spend money on equipment and products, and but nonetheless, 100% bonus depreciation coming back, and this is going to be between 2025 and 2029. This will really encourage a lot of additional spending from businesses to enhance their businesses. Now, Section 179 is kind of in a similar vein there. It's also related to expensing, things for like equipment purchases. That was capped at $2.5 million. Now it's going to be phased out at $4 million. So, and that's also indexed as well. So that's an addition. So that's going to be another helpful uh, ability for businesses to expense more for investments that they make into their business. So overall, as a business owner, this particular bill, I think, is very impactful for you in the sense that it makes it more attractive to invest in your business and get deductions and get research and development deductions. Um, the attractiveness of the qualified business income deduction staying in place. This is a very business owner friendly bill based on my opinion, and so these were some of the key aspects of it. Now, corporate tax rates did not get lowered. That was something that was talked about a lot in the campaign trail. That was just not part of this particular bill. So if you hear that or you read that, corporate tax rates stayed the same. So let's focus on the estate tax for just a moment, or what some people call the death tax. So based on the current law, let's just say you're a husband and wife, you're worth $27 million. You should be able to pass that entire level of wealth at $27 million down to your next generation tax free. But for your assets that are over $27 million, let's say you're worth $100 million, well, that other $73 million of wealth is going to be taxed at 40% at the federal level, roughly. And the reason why I say federal level is because there's also state death taxes or estate taxes, depending on what state you live in. So, but let's just focus on the federal aspect here. $27 million currently, roughly, you could pass down tax free. The TCJA, the Tax Cuts and Jobs Act, which was again supposed to expire at the end of this year, would have brought that level down to around, let's say, $14 million for a married couple. So you could, instead of being able to pass down 27 million tax free, you'd be able to pass down about 14 million tax free. This additional $13 million would have been taxed at around 40%, right? So millions of dollars in additional tax liability by just the change in the laws. Now, the one big beautiful bill has just shifted this to 15 million per person, which is $30 million. You can pass down $30 million tax free to your next generation. Now, this is huge, mainly for those who are currently in a position where, number one, you have that much wealth or more than that, and you need to take advantage of estate tax planning strategies. The wrong way to think about this is, oh, well, this is great. This law is permanent, right? That's what I'm reading. That's what they're talking about on TV, is that this new law is permanent. So, we're worth $30 million or somewhere around that. We're just going to wait till we pass away. There's no reason to do any planning, and it'll just be tax free. That's the wrong way to approach this, mainly because let's just focus on a couple of these limits from the past. Back in 2008, the limit was $2 million per person. So you could pass down $4 million of wealth. Back in the year 2000, it was $675,000. So if you're relying on this actually being permanent, that is in my opinion, not a good strategy for passing down wealth. The way I would approach this is these are the highest levels we've ever had for estate tax exemptions, at least over the next few years, while this Congress and this president are in charge and they're able to keep these levels where they're at. Because who knows? Next year, when we have midterm elections, the balance of power could change, and there could be some major changes and concessions that the Trump administration has to make to get any legislation passed through. And that could be repealing or changing the estate tax exemption limits. Or, the next president, the next Congress after that, They could have a completely different view, as I mentioned earlier, on what they would do with taxes, which then could change totally estate tax planning. So, my recommendation for individuals who are in the highest level of net worth, and of course, you want to work with your advisor and your attorney to figure out if this makes sense for you, is to really start focusing on estate tax planning now because you want to take advantage of these higher limits. So, nonetheless, for those individuals in the highest levels of net worth in this country, this is a major, major benefit for you to take advantage of as a part of this new legislation. So, lastly, I'm going to focus on a couple of changes to green energy credits, and then I'll leave you with some statistics and a very brief opinion that I have. So, the green energy credits, for example, electric vehicles and solar panel credits, those are going away. And so, if you're someone who's in the market for those particular products, it may be in your best interest to purchase those before those credits go away. I don't know exactly what will happen to the businesses that are using those credits to be competitively, advantageous against others, right? So, for example, look at Tesla. Tesla Model 3 and Model Y vehicles are pretty competitively priced, and the tax credit makes them even more competitive. So when those credits go away, that's most likely going to have a negative impact to the overall business of Tesla. So what will they do? And we'll find out over the next couple of quarters. Will they lower their prices? And what's the overall game plan? Now, it's a bit of a gamble, right? Should you purchase the vehicle now and get the tax credit, or should you wait to see how the business adapts and the overall market to see if classic capitalism takes hand and brings down those prices to remain competitive, anyways? Lower profits potentially for Tesla. Who knows what exactly will happen? But that's a key difference: is these tax credits will go away. Now, areas like, for example, nuclear, which obviously doesn't apply to hopefully anybody who's watching this video. You're not buying nuclear power for your homes. Those types of credits are going to stay the same. And again, kind of going back to artificial intelligence, there's a lot of growing thoughts around nuclear power powering artificial intelligence because our current power grid really doesn't have the capacity to do that. And so, one of the reasons why I think this element was protected as part of green energy credits is mainly because of artificial intelligence. So, those are some big changes to tax credits, and kind of focusing now more a little bit about the statistics here. Now, depending on what you're reading and where you're reading, you might see different numbers quoted. So here's what I'll share with you. The expected GDP impact from this bill is a 1.2% long run increase in GDP. It's a good thing. And 938,000 more jobs are projected. Now, here's the cost aspect. It's expected to cost $3.8 trillion dollars in the sense of the deficit will increase by $3.8 trillion dollars over 10 years. So, a lot more debt on the books here. The main benefactors of this bill, based on the numbers, is middle income families. Those in the income brackets are those making household income levels of 17,000 to 130,000 a year. You are likely to see a 5 to 6% increase in after tax income. And so, and again, depending on what you're watching and what you're reading, you might hear, well, no, this really only benefits very wealthy people. And part of that is actually really true. There are some elements that really benefit very wealthy individuals. But you have to remember what I talked about earlier, which was if the standard deduction goes back down to those levels, if the income tax brackets all get shifted a little bit higher, that impacts everyone. And it really hurts those individuals at lower income levels because you've also had higher inflation over the years. So the cost of living is higher. And in addition to that, if taxes go higher too, it could really hurt the average household. So I see the benefits on the middle income. I see the benefits on very high net worth individuals as well. And so I do believe, some of those sentiments. And whenever I hear things like, "Oh, this only benefits very high net worth individuals," you have to remember some of that is partisan based. I also don't believe that this mainly benefits the lowest, income levels in society. That's also partisan as well. So you got to kind of focus on the numbers here, as I mentioned earlier, and see what actually is the benefit. Um, and lastly, as I mentioned earlier, when they say permanent, none of this is actually permanent. There will be some changes. Some of these elements that were supposed to go away and expire aren't going to expire now. But again, take advantage of these changes while we have them. Work with your tax advisor, work with your financial advisor. If you're someone who's, for example, planning to sell your business, There's a lot of benefits now from an estate planning perspective, tax planning, maybe enhancing your business before you sell it by investing in some more equipment, or maybe potentially developing new products and doing more research and development related expenditures. There's a lot to take advantage of over the next few years. So do that. Take full advantage of it. And don't expect this to actually be permanent. As we've seen over the years, things change frequently. But for right now, there are some awesome tax advantages from this new particular bill. I hope you found value from this video. And if you have any questions or would like to dive into any of these topics further, please don't hesitate to reach out. Thank you so much for watching.